Okay, it's recording now. Okay, let me go to the Excel worksheet. There you go. Okay, so we continue with the topics from section D of your syllabus. uh, Factors that determine the capital structure in companies. Yeah, what we were talking about just now. An evaluation of financial models related to the capital structure decision. Equity capital, including cost of equity, CAPM, which we have already covered. Issuance of shares, loan capital, capital gearing, many aspects of company gearing, why companies borrow, factors influencing level of gearing, debt versus equity, capital structure debate, traditional theory versus theory, and the concept of financial risk in relation to gearing, what we were talking about just now, concept of business risk in relation to operations, and proportion of fixed overheads in their cost structure. This is called leverage analysis. Yeah, this part, leverage analysis. So then weighted average cost of capital, which we have already covered, uh, and dividend or internal investment. So those parts which we have covered, I won't be talking about them. Let us see what are additionally the things that we need to learn. Yeah, let's start off with four factors that determine the capital structure. What does it mean by capital structure? Yeah, what does it mean by a debate related to capital structure of listed companies? What is the capital structure debate? I think somebody's mic is on. Can you please mute it? Please mute your mics unless you want to ask a question, yeah? Someone's mic, please. Okay, yes, thank you. So capital structure means the mix of debt and equity. That's the meaning of capital structure. All companies start off as equity finance companies. When you get a listing for your company on the stock exchange, the listing is not by issuing debentures. The listing is by issuing shares. So in finance theory, what we have is this, that uh, all listed companies start off their life on the stock market as all equity finance companies. Why? Because when they are listed for the first time, the only listed security that they have are shares. They do not have bonds. So theoretically speaking, all companies start off their life on the stock market as all equity finance. Down the road, few years down the road, if they issue bonds, then they become geared. Yes, and so that is when financial risk and all that becomes relevant. And that is where all the theories related to capital structure then ask the question, hey, if a company has issued shares and now it issues bonds for the first time, will the risk structure of the company be affected? The answer is yes. The financial risk of the company will go up. What is financial risk? I've told you, in the world of finance, financial risk means borrowing risk. That's all. No more, no less. Yeah, financial risk means borrowing risk. And capital structure then becomes a point of discussion when a listed company issues bonds for the first time. So then, of course, flowing from this, there's another question. So if company can issue bonds, the benefit of issuing bonds is you know exactly how much you have to pay. The interest cost is fixed for you based on the rating agency's rating, yeah, whether you get a triple A or double A, B or something like that. Now, so if you go through that process of getting your bonds rated and then uh, issued to the uh, institutional investors, because in Malaysia, bonds are not issued to individuals. Yeah, like you and me cannot go and buy the bonds directly, but we can invest in unit trusts that buy the bonds. Yeah. So bond market is a little regulated in Malaysia, and Bank Negara manages the software for all of these things because it's borrowing, you see. And then, of course, we have our rating agencies, Mark and RAM and all that, who will do the rating. These days, I see that Malaysian companies, they like to use international rating agencies as well, because they are thinking that even though my current issue of bonds or sukuk is local, maybe my next issue might be international. Yeah. I might want to raise money in the international market. So it's good to get Fitch or Standard and Poor or Moody's or people like that. Yeah. Okay. There you go. How do we measure capital structure? A few days ago, someone asked me this question. I have seen a formula where they have worked out gearing, but they have used market value of bonds divided by market value of equity plus market value of bonds. How is it possible? So, of course, it is possible, yeah, because when we work out gearing or capital structure for ratio analysis or financial analysis, we normally work out gearing at book value, yeah, which is book value of long-term liabilities divided by book value of shareholder equity. We call that debt to equity ratio. Yeah. So this is sometimes also called debt to equity ratio. Uh, but in finance theories, we also use market value. Yeah. Uh, Two people who you will be meeting, Modigliani and Miller, when they worked out gearing, they based it on market value. Yeah, market value based gearing. So they took total market value of bonds divided by total market value of equity plus market value of bonds. Yeah. So you will remember in cost of capital, we use this, isn't it? Now, in finance theory, when they take total market value of bonds, this is sometimes stated as, yeah, or this is sometimes stated as uh, debt into 1 minus t divided by equity, sorry, equity plus debt into 1 minus t. Yeah, based on certain uh, assumptions that Modigliani and Miller had made, they used this version. Yeah, especially when it comes to gearing and de-gearing the beta, then we use this version. So I'm just giving this to you for sake of information sahaja. Yeah. I don't expect that you will actually be doing much with it. But you need to know that gearing can be defined in more than one way. So don't be alarmed if the examiner asks you, please work out gearing using this method. So basically, what are we saying? If you work out gearing using book value, so then you are looking at the book value of equity and book value of debt. That means the original value of capital contributed. Book value of equity, yeah, by the way, book value of equity, book value is equity plus book value of debt equal to total. Uh, we normally don't use the word total, we just say contributed capital. Yeah, you might see this word being used, contributed capital. And we use this when we work out market value added, for example. Yeah. Ah, yes, now it works. What are the factors that determine gearing? Well, how much a company borrows depends on what the company has done so far. There's a theory called a pecking order theory, and using pecking order theory, the suggestion is that firms will first use internal finance whenever the company needs new long-term financing. Yeah. So this relates to long-term financing. When the company needs long-term financing, they will first use internal finance. So this internal finance is basically retained earnings. There are many, many, many studies around the world that have shown that retained earnings is the single most important source of money. Doesn't matter whether you're a British company or a Japanese company or European company or indeed a Malaysian company. Yeah. First of all, we use whatever money that we have reserved in our company before we go and borrow. Yeah, that's considered good financial management because you have control over your money. Secondly, uh, if we go out, then the first thing that we do is we do private borrowing. Because when you want to do borrowing related to issuance of bonds and things like that, uh, there's a lot of procedure involved. Yeah, you have to get all your placement documents. If you're a listed company, you have to give reports to Bursa to give justification why you are doing this. You have to give your submissions to Securities Commission before they can approve your new equities. They have an equities issues department that looks at these things. So there's a lot of process involved. So usually companies, after using up their retained earnings, if that's not enough, then they will plan to talk to the bankers. Yes, but nowadays the interesting thing is that between uh, bank borrowing or between your own money and issuing bonds, there are a lot of things in between. Yeah, so you have new innovations like private equity funds will come in here. Yeah, before the bond issues. So these are new things which have come up after this theory was made. Yeah, private equity, crowdfunding, uh, etc. Yeah? Angel finance, da 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 da. Yeah. Okay. So basically, the theory is still relevant. Companies will still prefer using internal money as opposed to external money. When they go out in the market, they will prefer to use those sources of finance which are more private rather than those that are full market sources. Full market sources are issuance of bonds, and if they feel that they have issued enough bonds or they have enough gearing in the company, then and only then they will issue shares. So the point that this theory made, and there's a lot of empirical evidence to prove it, that companies will go to issuance of shares only if number one, they have a large sum of money to raise, if the quantum is very big, and number two, the other sources of finance are already used up mostly, yeah, or exhausted already. Then they would go and issue shares. So only issuing bonds on the stock market or issuing shares on the stock market will affect the capital structure. So when we talk about capital structure theory, those theories are only talking about these sources. Yeah. But of course, the pecking order theory is a complete theory. So pecking order theory says that when a company needs to expand, when they want to use their money for long-term capital expenditure, then their long-term money will come first internally, then externally privately, and then externally public borrowing, and then finally shares. So these are the four steps, if you like, yeah, the four phases through which a company will go. Okay. So the factors that determine gearing depend on which level you are at. Companies with low gearing would of course prefer to issue bonds. Yeah. So that's another factor that determines whether you're going to issue bonds or you're going to issue shares. The another thing that would affect your decision of whether you're going to raise money using borrowing or equity is the relationship between short-term interest rates and long-term interest rates. We call that term structure of interest rates. Long-term interest rates could become higher due to higher risk of repayment. But this is a general statement. Sometimes short-term money is more expensive, yeah, uh, because short-term money is easier to raise, and short-term money does not have so much of credit filtering. If it does not have enough of credit filtering, then it's expensive. I mean, if you want to borrow from a bank, a certain personal loan or something like that, you may have to go through a process of evaluation, which might be quite thorough. But if you go to a private lending company, maybe the process might not be so thorough. Yeah, they say, bagi IC cukup sudah or whatever, and then they give you money and then they tie you down, but with terribly high interest rates. Yeah, and that's why for some time, I think uh, during the economic crisis, this was a Malaysian issue actually. And we used to read of this Alongs, the very, very harsh money lenders yeah, in Malaysia. Yeah. You will be surprised. That kind of thing is not just Malaysian. Yeah. Uh, it is generally Asian. Yeah. And I have seen this working in other economies as well. Yeah. Okay, so anyway, factors that determine gearing depends on your business requirements. If smaller amounts, you can use internal finance. If reasonably bigger amounts, you go for external borrowing. If very big amounts, then you need to go for issuance of bonds or shares. Secondly, uh, the existing level of gearing. Yeah, if your gearing is still low, you can afford to issue bonds. If your gearing is already very high, then probably you need to consider planning for an equity issue, because equity issue is not something that today we decide next week we can issue shares. No, it takes anything between 3 months to 9 months to get all the paperwork going and then finally have the issue. Yeah, so um, we want to try to bring it down to below 6 months in Malaysia, but it still takes 6 months or more. Yeah. So then we have long-term interest rates. Okay, that we talked about it. Then the company's debt rating from agency is another thing that will need to be considered when you're issuing bonds. So the capital structure issue only becomes an issue when you issue bonds. Yeah, I say that again. All listed companies start life as equity finance companies. So when you are a pure equity finance company, you have only issued shares, then capital structure is a non-issue for you because you are all equity finance. But capital structure becomes an issue when you issue bonds for the first time. Yeah. So either you have Mark or Rating Agency of Malaysia. It's not Malaysian Rating Agency. Yeah, it's Rating Agency of Malaysia, RAM. Fitch, Moody's, Standard and Poor, da da da. Yeah. The expected impact on financial risk. So as we said earlier, risk can be business risk or financial risk. If you are talking about business risk is impacted how? If you move into high risk business, then this will go up. Financial risk will go up how? Borrowing will increase this. Yeah. And this is reflected by a higher beta equity because risk to whom? Yeah, borrowing will increase uh, financial risk to equity shareholders. Equity shareholders now, when profits are made, the company will have to pay interest on loan first. They would have to repay the loan first before they can consider payment of dividend. So when companies borrow money, who is taking the risk? Equity shareholders. This is why This is reflected by a higher beta equity. Yeah, we call it a geared beta. Some terms to note for betas. Yeah, uh, debt beta means the market risk of bond. We call it debt beta or beta debt. Yeah, equity beta is the market risk applicable to equity shares, and geared beta means, and this is where you have to be careful, people mix it up. Geared beta means the equity beta of a company that is geared. Uh, so geared beta is equity beta of a listed company which has issued bonds. Okay, which has gearing means, i.e., has issued bonds. Uh, i.e., has issued bonds. Oops, bonds. Okay, models relating to capital structure. uh, Two main models, as your syllabus pointed out just now, traditional model and the Modigliani and Miller model. Modigliani and Miller model has two versions, one without tax and one with tax. Yeah. So what does the traditional model say? I have given you the detailed notes of this the last time. I gave you the uh, Excel worksheet. Yeah. So you already have these notes there, but today I'm just touching on this because those notes I gave you, but we didn't discuss. Yeah. So models related to capital structure, you have the traditional model of capital structure, which is a complete model. It says that the market value of a firm is impacted by the capital structure. If an all equity company issues bonds for the first time, the overall market value of the company will tend to increase, go up. And you might say, hey, how is that possible? Because when it issues bonds, it is true financial risk will go up. It is true that KE will go up because higher risk for equity shareholders. But bonds tend to be cheaper. Borrowing tends to be cheaper, number one. Number two, interest paid on bonds is tax deductible expense. So borrowing is a very efficient way of raising long-term money, issuing bonds. It is cheaper, and also the interest is tax deductible, making it even more cheaper. So when a listed company first starts issuing bonds, the overall cost of capital K naught will actually come down slightly. And if they keep issuing bonds over the years, they may find that the K naught will continue to actually come down, resulting from further increases of issue of bonds. After some time, when the company issues bonds or some companies don't issue bonds, K naught tends to flatten out a little bit. And if a company continues to issue bonds to finance its business, then the K naught is expected to go up. That's the theory. Yeah, it is expected to go up because after some point, the increase that is required, the compensation required by KE to increase at a very high rate. So whatever savings that you had with cheaper borrowing are actually negated because now the shareholders are a little concerned that the borrowing level is going too high. So what should listed companies do? They should operate at a capital structure that is acceptable to the market. They should operate at a good mix. We say the optimal mix of equity and debt. So the value of the firm will be maximized when the firm operates at the optimal mix of equity and debt. That's the traditional model. The notes, the detailed notes are already with you. Modigliani and Miller in 1958, they wrote an article in the Economic Review magazine, and they said, well, you know what? We have studied listed companies in the stock market and we found that capital structure has no impact whatsoever on the value of the firm. No impact. Yeah. And they provided mathematical evidence showing that we believe why this is happening. Of course, when you present a paper, you present research, you have done empirical research and you have found a phenomena. The phenomena is that there are two companies we have seen, listed companies, both in the same market segment, both having more or less same market footprint. Yeah. Um, one is geared, one is not geared, but when we worked out their cost of capital, overall K naught, we found the overall K naught to be the same. If the overall K naught is the same, that means their capitalization rate, the rate at which investors turn the required return into value, is more or less the same. So there is no real difference on firm valuation caused by differences in capital structure. They provided mathematical evidence of arbitrage to show that this is what investors would do. And basically, the arbitrage system was this. They made some assumptions, of course, yeah. Assumptions relating to perfect capital market, very rational investors, everybody has access to the same kind of information. And if I have invested in a company that was geared. Now I sell off my shares in the geared company. And if that company was geared 40% and I sold off my shares, so I will see what is the proportionate increase in my personal gearing. They believe that your personal gearing, the risk that you take with personal gearing is the same as the risk that you take when you invest in a geared company. Now, many people would argue that's not true. Yeah, you borrow money personally is of course 100 times riskier than just investing in any listed company who has borrowing. Yeah, the value of the firm, of course, well, they made several assumptions, including one that said that there are no taxes. Yeah, so they said we don't agree with this. And this is our mathematical evidence. So people looked at it and they said, well, few things have happened here. Firstly, because the companies that you are looking at are very established and they are already at the optimal capital structure. Now, at the optimal capital structure, your cost of capital goes down, flattens out for a while, and then goes up. So many of the companies that you have studied are already operating at the K naught that is optimal. So that's why it looks like a straight line. Your empirical evidence is not the full story, it is just the midpoint. Firstly. Secondly, they said, we don't agree with your assumption that there are no taxes. Show us one company that does not pay taxes, yeah, based on your sample. So, of course, because they were looking at American companies, unless they are connected to Donald Trump and they hide their taxes, everybody pays taxes, yeah. Today is the day for making fun of that joker. Okay. Anyway, in 1961, Modigliani and Miller said, okay, let us adjust this, our assumption. Now we tell you, if two conditions are satisfied, both must be satisfied, yeah? Companies pay tax and interest is paid on tax is an tax allowable expense, then the more the company borrows, the more they can save in tax. So now they brought in a new variable that uh, when companies borrow, they become more tax efficient. If they become more tax efficient, the more they borrow, the higher will be the tax savings. How much is the tax saving? Well, it is measured by this value, the total market value of debt multiplied by T, the tax rate. Yeah. So they said that the value of the company when it becomes geared after issuing bonds is equal to the value of the company when they had not issued bonds yet, they were ungeared, and plus the value today, we say the present value of all the tax that they are going to save because now they have issued bonds. So the formula is VG, value of the firm when it becomes geared, equals to VU plus DT. So as long as you borrow more, the value of DT will of course become more. So now they changed their story and they said, oh, you should borrow as much as possible. Then people said, well, that doesn't sound very right. So then in later discourse and discussion in articles, then they have said, well, you know what? Companies should probably borrow how much is acceptable to the market. Now, why do we study this when they took us on a big wild goose chase, it would seem? The important thing is this theory has highlighted one thing, and that is there was too much emphasis placed on companies trying to find an optimal capital structure. So basically, what they said was optimal capital structure is important, but it is not the only thing that you have to worry about. Yeah, there must be other things that you must look at. However, now uh, at the present state of the discussion, Modigliani and Miller theory with taxes and the traditional model tend to overlap. Yeah, tend to overlap in their output, in the suggestion that the theories have made. Yeah, and so if you're answering this question, that's how you would balance it off. That in practice, uh, it is found that the Modigliani and Miller model with taxes more or less equates to the traditional model, yeah, which is a complete comprehensive model. That's it. That's how you would answer this question. Yeah, theory, all theory. Okay, now the next part here is uh, any questions on this, by the way? All okay, huh? Make sure you write the essay. It's very important. You have to write the essay, people. Yeah. Okay, concept of financial risk, concept of business risk in relation to operation and the proportion of fixed overheads. You see, there are two types of risk we said, isn't it? Financial risk, which is borrowing risk. The other risk is business risk. Now, one of the main things that causes business risk or why business is risky is because uh, business is a situation where many costs are fixed, but income is variable. So, what do you mean by business risk? Business risk is a scenario, is a situation of trying to cover fixed costs with variable income. If income was fixed and costs are fixed, no problem. You know how much you're making. Yeah, that's why risk-free investments, no problem at all. You know what you are getting. So how do you measure for this? Yeah, how do you measure for this? The concept of business risk in relation to areas of operation and the proportion of fixed as overheads. Yeah, answer, you work out leverage analysis. So this word leverage, many American textbooks use the word leverage interchangeably, meaning gearing. But you must understand gearing is one type of leverage. It is financial leverage. Yeah, because leverage can be of two types. If you have a fixed cost in your business operations, then that is called operating leverage. If you have a fixed cost of repaying a loan, then that is called financial leverage. Yeah, so fixed overheads are a source of business risk for sure. Yeah, we have seen during our recessions, what happens is, like now, even during COVID, many companies have realized their incomes have been cut, but many of the costs are fixed. Why do you think companies are going bankrupt now? Because their rentals, they have to keep paying, they are fixed. Their salaries, if they are good people, they are still paying, they are fixed. That is the risk that they are facing, isn't it? Uh, so the higher the fixed overheads of a business, the more impacted it is by fluctuation in income. So therefore, the more impacted it is by business risk. That's what it is all about. Um, so fixed overheads can be fixed operating overheads or fixed financial overhead, of course. Fixed operating overheads are measured using degree of operating leverage, we call it degree of operating leverage. And fixed financial overheads are measured using degree of financial leverage. Yeah. There has been one question even in the old papers on this. It's actually sometimes asked as part of your ratio analysis because it's also ratios. Yeah. The overall impact of fixed overheads is of course measured by multiplying operating overhead with financial leverage. Yeah. So degree of total leverage, that's the formula, DOL multiplied by DFL is equal to uh, DTL. Let me just put this DTL. DTL to DOL times DFL. Yeah, that's the story now. Where DOL is the degree of operating leverage and it's measured by this EBIT. Yeah. Plus your fixed operating overheads divided by EBIT, and financial leverage is measured by EBIT divided by EBIT minus the fixed financial cost. So please be careful. For the first formula is EBIT plus fixed operating overheads. For DFL, it is in the denominator and it's minus your fixed financial costs of loan repayment. That means minus your interest charges. And then DTL is of course DOL multiplied by DFL. And the rule here is that if the value is less than 3, it's considered low risk, good. If value is 3 to 5, it's considered moderate risk, acceptable. If value is greater than 5, it's high risk. Okay, so I have an example here which I've worked out for you. Let me change the story a little bit so that we can practice this. Yeah, let me say this is 88,000 fixed operating overheads, 68,000, and the fixed financial costs, uh, 8,000. So can you work out for me please using these formulae? What would be DOL, DFL, and DTL? Let me show you the. If the question does not give you EBIT, sometimes they give you operating profit. Okay, so in exam questions you could get EBIT or operating profit is also possible. You want to work out DTL. If DTL is less than 3, it will be considered low risk. 3 to 5, moderate. Above 5, high risk. So in this case, the DOL will be equal to I'm not sure how to answer that. Yes, that's okay. My phone is very kepochi. The EBIT, which is 88,000, maybe I can just write here, will be equal to, in brackets, 88,000 minus fixed operating cost 68,000 divided by EBIT again, which is 88,000. Yeah. Sorry, plus, not minus. Plus. And then you get here equals 88 in bracket, 88 plus 68 divided by 88. You get 1.77 times, I believe. Yeah. And DFL is equal to 88,000 divided by now 88,000 minus the fixed financial cost 8,000. Okay, and that would be equal to 88 divided by 80 lah, 1.1 times, so that the total leverage is 1.77 multiplied by 1.11, which is 1.95. And you will find, oh well, this is pretty safe because the break-even change in revenue that the business can withstand is very high. Their break-even is 51.28 actually. Now, how did I get this break-even? What is break-even? Break even means that level at which we don't make profit, we don't make loss. Yeah. So in this case, what we are saying is, let me just put it to you like this. Yeah. DOL is actually a measure of percentage change in operating profit or a 1% change in revenue. So if my revenue targets are not met, yeah, if my revenue targets are not met, uh, and I'm 1% short of my revenue, for every 1% that I'm short, how many percent does my operating profit fall? In this case, 1.77 times. Yeah. Then DFL will do percentage change in net profit after tax, net profit after tax for a 1% change in operating profit. That's why DTL then, when you multiply the two, becomes the percentage change in net profit after tax for a 1% change in revenue. Because you multiply the two. Yeah,
I have one question.
sure.
How come you how you get 1.95 there?
I multiplied 1.77 times
Uh-huh.
1.
Times 1.1.
Yeah,
Okay. Thank
yeah,
you.
1.77 multiplied by 1.1, 1.25.
Okay, thank you.
Okay, welcome. Okay, so this is, if you like, the actual meaning of what you have done. This is the formula on the left is the calculation. This is the meaning, yeah, what you explain. So DTL is very important for us, this value really important for us because in budgeting, we want to know if our budgeted revenue cannot be achieved, how will it affect our bottom line? Every business wants to know that, especially now with COVID and all, going forward. But in any scenario, because a company has fixed costs and that fixed costs create risk, we want to know if our revenue falls, if our income falls, how will it affect our profit after tax? Will we be able to cover all our overheads or not? Now, the story here is that DTL is 1.95 times, almost 2 times. So what we are saying is, if my sales projections are 1% down, my profit is 1.95% down. So if my sales is down by 10%, then my net profit is down by 19.5%, isn't it? Then I want to ask myself, okay, if that is the case, how much can my revenue fall before my net profit becomes zero? Well, your net profit will become zero if net profit falls by 100%. That's break even, isn't it? Anything fall by 100%. No more profit, no more loss. So that's why for break even, BREAK, isn't it? Break even, uh, we take the formula 100% divided by DTL. You see, this one we call it times, by the way. 100% divided by 1.95, I will get 51.28. Now, this is an application of sensitivity analysis to your budgets and your cash flow projections. What is the interpretation? All other things being equal, because this is sensitivity analysis, you're changing one factor. All other things being equal, if revenue falls by 51.28% for this company, then uh, net profit after tax will be wiped out. No more net profit after tax. Yeah. So sales or revenue must fall by more than 56.25%. In this case, 56.28%. Because I changed the example a little bit, isn't it? Yeah. Before this company starts to make losses. Okay. I would just like to put one more example here just to make sure that we are all okay with this. Yeah, so what I'm going to do is I'm going to copy this formula for you and I'm going to put it on this side. What do you know? Yeah, X files. Then I'm going to give you some data. Let me give you some reckless data. Yeah, so if EBIT, our operating profit was 35,000 after charging fixed operating overheads of this. Yeah, so we made 35,000 operating profit, and our financial costs, although our operating profit was 35,000, our financial costs, let's say if my interest cover is this one, let's say 12,500 lah. Now can you please work out for me DOL, DFL, DTL, and the break even? 2.94 times. I got my DFL, DOL. My DFL would be um, 5 divided by, in brackets, 35 minus 12 by divided by, in brackets, 35 divided by 12. Whoa, what did I do? Say we do that again. 35 divided 12, 5, close brackets. 1.56 times. So that DTL will now be equal to 2.94 multiplied by 1.56, and you get 4.58 times, but still within the acceptable range according to what good financial management experts say. Yeah, that this DTL should be 5 times or less. Break even, where your net profit after tax falls by 100%, would be 100% divided by DTL to 100 divided by 4.58, giving us a break even of about 21.84%. So you see, this is what the experts of the world are saying, that any business projection, if your projection is such that uh, your idea of how much net profits you make will be sustained as long as your budgeted revenue does not fall by more than 20%, then your business risk is okay. Yeah. So as a measure of business risk, if I have projected or budgeted my sales and my sales revenue, at my sales revenue, I got a DTL of say 5 times exactly, it means that my business can withstand a fall of revenue 20%, and I still won't be losing money. My profit will be wiped out. Yeah. If my DTL is 5 times, then my break even will be 20%. And I will start losing money only if my revenue falls by more than 20%. Hmm? That's how it works. Okay, make sense? Any questions at all?
Sir,
Hmm.
sir,
Yes.
may I know why to find the DOL, we use EBIT to plus the overhead, but to find the DFL, we use EBIT to minus the finance overhead. May I know why is this formula?
Okay. Okay, that's a fair question. Uh, we are saying that before we arrived at this profit, operating profit, these are the fixed overheads that we charged. So you see, the way the formula works is this: bigger the fixed overheads, bigger will be your risk here, your operating leverage. So the way that this formula is designed is to show the effect of fixed operating costs. So fixed operating costs are before your EBIT. That's why we add them back to see how they impact the risk. But financial costs come after EBIT, because EBIT means earning before charging interest and tax. So interest and tax come after, you see. This is why when we did DFL, we have the financial costs in the denominator and we minus. Yeah, because now what we are saying is, for DFL, this is our operating profit. By how much is our operating profit reduced? Because we are paying interest to the bank. By how much is our operating profit becoming less? Because we are using a chunk of it to pay interest to the bank. So the bigger the chunk here, the bigger the 12 here, the bigger will be this number. Yeah, that's how it is. So you see, yeah, I show you like
Okay.
this. Come, let us test and see lah. Let us say now my operating profit here, instead of 35 was only 20,000, and my fixed operating cost was still high, and still paying fixed financial costs like that. Then you see my leverage went up to 11.3, isn't it? That's what. That's how it works. Okay.
Okay, thank you.
Welcome. Okay, let's take a short break, and when you come back, I will talk to you about dividend policy, shareholder value added, and market value, because I think these are some of the theories that you need to cover to be ready for your examination. Yeah. So let me now uh, stop the recording. Stop recording. Good.